You're welcome to your regular market and investing program, the DLM Bondshow. Today, we'll be discussing another interesting topic, monetary policy and the bond market. We meet to discuss this is Mr. Adetola Odukoya, Vice President, Investment Research, DLM. You're welcome, sir.
Thank you.
To have you again.
Thank you.
DLM Bondshow. And like I said, the monetary policies of the US Fed and central banks across the world has impact on the bond market. But first, we want to know nutshell, what impact monetary policy has on the bond market?
Well, the impact of the of monetary policies of various central bank of any central bank within any economy can never be overemphasized. Essentially, it really dictates the direction of interest rates, and interest rates also have a very strong, albeit inverse, relationship with bond prices and activities in the bond market. Now, coming down to the Nigerian environment, over the last 2.5 years or 3 years or thereabout, we've also seen the impact of monetary policy. In this instance, movement in the benchmark rate, which is the monetary policy rate, as we call it in Nigeria, or what you would call the Fed fund rate in the US. How the impact, the movement of the MPR in Nigeria has impacted the domestic bond market.
So far, we've seen some very stringent measures. Would you say that the MPC so far, in terms of the interest rate, has favored the bond market in Nigeria?
Well, I will put it this way: it's a two-edged sword, and that two-edged sword has two schools of thought in economics. Competing in the case of Nigeria, as you put it. Now, over the last 2 years, I mean, ending Q4 2011, when the monetary policy MPR was moved from about 9.25 to 12%, the school of thought there is saying that if you want to check inflation, if you want to stabilize exchange rate, you move your benchmark rate up. Therefore, what that means is that the federal government or the central bank or the monetary authorities in this case are saying, for us to take money from you or for us to borrow money from you, we will pay you a higher rate of interest. If you remember, about 2 weeks back, I mentioned this, the AAA issue of the federal government issuing securities. So what this means is that, let's just say for the sake of simplicity as an example, if prior to that point, the federal government was borrowing at 9%. Now the federal government is saying, because it wants to take liquidity out of the system, because we have to note, that's also part of the key reasons why you have monetary policies, either to put liquidity in the system, and when I say liquidity, I mean cash, or to take liquidity or cash out of the system. Now, in that theory that says that for you to take to check inflation, right, you need to increase interest rates. What that means is that the federal government is saying, for example, we were borrowing before at 9%. Going forward, we want to start borrowing at 12%. Hence, the movement of MPR from about 9.25% to 12%. So what that means is that government securities now becomes very attractive to the average investor. And what that means is that in achieving that aim of taking liquidity out of the system, you and I will most likely give more money to the government, i.e. either in form of treasury bills as issued by the central bank or federal government bonds as issued by the Debt Management Office, or DMO. So at the end of the day, you find out that because you have a higher rate of interest or return from such relatively risk-free securities within any domestic economic environment, you have investors moving towards those securities to invest in them, thereby taking cash or liquidity out of the system.
For IMF recently, prior to the time where we were uncertain of the resolution of the impasse between the White House and the Congress on the debt ceiling, had warned that the faltering will affect about 2.3 trillion bonds, and this is about the issue of the US tapering, the Fed tapering. And we've seen that the nominee of for the next Fed chairman, Professor Yellen, is one that will not, from analysis, want to go the tapering line. But in a nutshell, what is the effect of a Fed tapering on the global bond market?
Well, let me continue from where I stopped earlier. You know, I mentioned two competing schools of thought.
Yes.
One saying for you to address inflationary concerns and exchange rate stability, you need to raise interest rates. The other school of thought is saying in certain environments, in certain economies, when you want to stimulate economic growth, you put money or you release liquidity into the system. And as a result, what do? You reduce interest rates within the economy, starting with the rates as determined by the Monetary Policy Committee, which is the MPC that we have in Nigeria, or what you call the FOMC in the United States. Exactly. So essentially, what they've been doing is that they've been paying more attention to domestic growth, i.e. growing the economy, creating more jobs, and by targeting such initiatives, they are releasing liquidity into the system. And one key way of doing that is by reducing interest rates, that is the rate at which the federal government is borrowing. And they also have been doing this significantly off the back of quantitative easing, which is QE. And what that simply means is when the Central Monetary Authority, which is the Fed in the US, the Federal Reserve, or the Central Bank in Nigeria, would actually buy bonds or government securities off holders, i.e. Financial institutions. So let's say, for example, you have about 500 billion naira worth of bonds sitting in various institutions in Nigeria, both banking and non-banking. The Central Bank of Nigeria, if it was pursuing economic growth, right, and job creation and so on and so forth, would now say, okay, I will put 500 billion into the system. You give me these securities to hold. So in buying those securities of those institutions and individuals, you are putting cash into the system with the hope that they would go ahead and expand their businesses, and thereby creating job opportunities and increasing domestic production, thereby stimulating domestic economic growth. And that's what they've been doing in the US over the last 8 quarters, I think, under Bernanke. What they've simply been doing is quantitative easing by putting more liquidity into the economy, such that to drive economic growth, employment, and increase domestic production. And overall, you have sustainable economic growth. Because remember, once the rates are also low, it means small and medium enterprises, let's not even talk about the higher end, small and medium enterprises, who are actually the drivers of growth within any economic environment, are able to access funds for expansion, for starting businesses and creating job opportunities and growth at more sustainable rates. So if you're doing such things at more reasonable interest rates, that's essentially what you've been seeing in the UN's. Hence this talk about QE or quantitative easing, and recently the talks about the Fed tapering the QE initiative. The main highlight of the market last week was the OMO, open market operations of the central bank, where about 500 billion plus was issued into the market, of OMO bills was issued into the market. And obviously that's on the back of, in the previous week, there was a spillover. Remember, we had a very short week as a result of the Eid celebrations, and during that week, during that holiday period, the markets were closed. And during that same week, we had a lot of liquidity in the system through budgetary disbursements, which we all generally call FACO allocations, and also the release of some funds to PHCN staff, severance pay for PHCN staff. So the spillover effect of all that liquidity in the system into last week, it made CBN come to the market with a lot of aggression, issuing about over 500 billion naira worth of OMO bills, essentially to mop up that excess liquidity out of the system. Remember, we have a contractionary monetary policy stance in Nigeria, where we're looking to take as much liquidity or cash out of the system. So that was the major highlight last week, although there was a bit of elevation also in the maturity of some OMO bills. Well, that was about just a little over 100 billion that matured. That really, but it was the excess cash that came into the system that made the central bank mop up that excess liquidity, and so that was essentially, so that really overshadowed even the treasury bills auction, and that occurred during that week, where rates were between 12.5%, and the OMO bills were a bit more higher, because obviously investors preferred that window because they could get a slightly higher yields or returns on investments compared to in the Adetola bills auction.
And so it has been a very interesting session learning about monetary policy and the bond market. Indeed, monetary policies has a way of affecting bond markets, not just the bond market, the stock market, and generally the economy. And so we've had a great time this month looking at different aspects of policy, state, federal government, and even the Eurobond. But next month, we will be having different segments of the financial market to analyze. And so till next month, keep it with your regular market and investing program, the DLM Bondshow.